Welcome back, everyone, to the Audacious Witch channel, where we talk about the magic behind the stock market. Artificial intelligence got the bulk of interest from tech investors in the past couple of years, but it's not the only tech sector with upside potential. One industry that is delivering solid growth and still has a long runway ahead of it is ad tech. Digital media has transformed advertising. Alphabet and Meta platforms are the biggest winners in the industry, but there are others benefiting as well, including ad tech companies taking advantage of continued growth in areas such as connected TV, retail media, better ad targeting, and improvements enabled by AI. Two of these ad tech stocks that can make investors a fortune. Number one is Roku. Roku's stock price remains down more than 80% from its peak in 2021. That's when the pandemic-driven boom quickly faded as the economy reopened and the streaming industry's surging growth hit a wall. Roku was forced to do several rounds of layoffs, having overspent during the pandemic, but the business and the streaming industry more broadly underwent a reset and are prepared for growth. Netflix stock soared to an all-time high recently as its ad tier has taken off. Walt Disney is now making a profit in streaming division. And the stock recently hit a 52-week high, while Warner Brothers Discovery is splitting into two companies, one focused on studios and the other on streaming. Streaming services appear to be moving past their post-pandemic struggles, and Roku should benefit. Despite the stock's woes, the business continues to deliver solid growth, with revenue up 16% year over year in the first quarter to $1.02 billion, and its bottom line is improving as well. The company also expects to report an operating profit using GAAP metrics. There are also other signs of building momentum. The stock price jumped on Monday after the company announced an exclusive integration with Amazon's demand-side platform. Roku and Amazon Ads have announced a new integration that will give advertisers access to the largest authenticated CTV footprint in the U.S., exclusively through Amazon DSP. This partnership means advertisers can reach an estimated 80 million U.S. CTV households, which represents over 80% of the U.S. CTV. This collaboration will allow advertisers to place ads across a wide range of content, including the Roku channel, Prime Video, and other streaming services available on both Roku and Fire TV platforms such as Disney+, Paramount+, and Tubi. Improved targeting and efficiency. The core of this partnership is Amazon's DSP, which will leverage a custom identity resolution service to recognize logged-in viewers across Roku devices. This aims to increase unique reach. Early tests show advertisers reached 40% more unique viewers with the same budget. Reduce ad repetition. Ad frequency for viewers was reduced by nearly 30%, leading to a better viewing experience and less ad waste. Enhanced measurement. By combining data from ads served on Roku with Amazon DSP insights, advertisers can gain a more complete understanding of how their campaigns drive outcomes. This partnership is seen as a strategic win for both companies. For Roku, it strengthens its ad business and platform monetization. For Amazon, it expands its already robust advertising capabilities and provides a more unified solution for advertisers navigating the fragmented CTV landscape. The full offering is expected to launch in Q4 of 2025, just in time for the holiday season. As the leading streaming distribution platform, Roku is well positioned to capitalize on continued growth in connected TV, and at a market cap of $11 billion, the stock could easily double or triple or better from here, especially if it hits its profit goal. Number 2, the Trade Desk. As the leading independent demand-side ad tech platform, the Trade Desk has been a long-time winner on the stock market. What's my investment thesis for the Trade Desk? The Trade Desk is an ad tech company that operates the largest independent demand-side platform DSP software that helps businesses plan, measure, and optimize data-driven advertising campaigns across digital channels. The company has a particularly strong presence in two of the fastest growing advertising verticals, connected TV and retail media. The Trade Desk independent business model, meaning it does not own media content and has no reason to steer clients toward specific advertising inventory, is an important advantage. It distinguishes the company from rivals like Alphabet's Google, Amazon, Meta platforms, all of which have an incentive to sell their own ad inventory to media buyers, whether or not it's the best option. Frost & Sullivan analysts recently recognized the Trade Desk as the most technologically sophisticated DSP on the market. The company has been building artificial intelligence into its software for years. Its 2023 launch of Kokai platform introduced new AI features that let agencies manage budgets, prioritize ad impressions, and target consumers. CEO Jeff Green said Kokai adoption was ahead of schedule on the first quarter earnings call, and he thinks all clients will be using the platform by year end. The Trade Desk is monetizing AI in other ways as well. Its recent partnership with Rembrandt will allow brands to use generative AI to create advertising content. The partnership expands its existing generative AI marketplace. Meanwhile, the company recently reorganized its sales teams to build direct relationships with larger brands rather than working solely with advertising agencies. It also restructured its engineering teams to ship smaller updates more frequently. Those changes have already had an impact on its financial performance. In the first quarter, the Trade Desk reported a 25% increase in sales and a 27% increase in non-GAAP earnings. The Trade Desk stock trades at a reasonable price. Importantly, the Trade Desk stock fell sharply after the company missed its fourth quarter revenue guidance. Investors worried that increased competition from Amazon could pose a serious problem for the company, but I think the market overreacted. The Trade Desk has built trust with its clients due to its independent business model, something that Amazon lacks. Indeed, Bairong Capital analysts believe the competitive landscape remains quite favorable for the Trade Desk, saying in the firm's first quarter report, the market has shown a strong preference for independent and objective platforms that are not vertically integrated with media owners. We believe large advertisers will continue to value the Trade Desk's independence, transparency, and neutrality. With that in mind, the Trade Desk is well positioned to grow its business. Ad tech spending is forecast to increase at 14.4% annually through 2030, according to Grandview Research. That should translate into slightly stronger earnings growth as the company continues to gain market shares, which makes the current valuation of 40 times adjusted earnings look reasonable. What's your opinion about Roku and the Trade Desk? In my opinion, two companies wouldn't merge at this point simply because Roku is working with Amazon, and Amazon is both Roku and the Trade Desk's largest competitor. I do think both of them have an unlimited upside ahead.